Good day, Dr. Judith Varga, Minister of Justice, Mr. Attila Soltas, President of IT Pro Society Association, Dr. Csaba Kandracsi, Vice President of the Hungarian National Bank, Your Excellencies, ladies and gentlemen. It's an honor and pleasure to address you at Infoparlament, which has been Hungary's leading conference for discussing digital policy issues for 11 years now. This year naturally focusing to a large extent on the regional aspects of digitization and digital transformation in the context of the COVID-19 crisis and recovery. My name is Otaviano Canuto, and for many years of my professional life, I had the opportunity to follow closely the trends of technological change and economic growth as a vice president and as one of the executive directors at the World Bank. I was also an executive director at the IMF and a vice president at the Inter-American Development Bank. After recently retiring from those institutions, I'm currently a senior fellow at the Policy Center for the New South and a non-resident senior fellow at the Brookings Institution. Let me touch on three topics of the rich agenda that you have been discussing along the conference. First, how the pandemic has accelerated the digital transformation. Second, I will mention some of the opportunities and policy challenges brought by the digital transformation in finance. Finally, I will briefly approach the issue of taxing tech, subject of international negotiations that shall bring consequence to the region, including the G7 Finance Ministers Agreement reached last week in London. First, on the pandemic and the digital transformation. The pandemic is accelerating history in the sense that it's leading to the speeding up of some recent trends, including the digitalization and digital transformation of economic processes. But it's also rewriting history because of the radical change that has come with that acceleration. The most decisive and intensive, epoch-changing digital technology transformation of all time is happening right before our eyes in the wake of the crisis. In just a few months' time, the pandemic crisis brought about years of change in the way companies and private and public organizations in all sectors and regions operate. Much of that is over now. And in the case of digital transformation efforts, it also served as a catalyst for change. Where do we see proof that the pandemic fast-tracked digital transformation? I recently read the results of a wide research done by Celerity, which is a business and technology consulting firm, with a substantial sample of US enterprise, where 63% of leaders said that the COVID-19 has made their organizations embrace digital transformation sooner than they had expected. 63% also said that they were making greater investments in technology on account of COVID-19. And 49% indicated that digital transformation was not a strategic priority prior to the pandemic's onset, but it has become one since. And those results match with another survey made by McKinsey. When respondents were asked why their organizations didn't implement these changes before the crisis, over half said that they weren't a top business priority, and the crisis had removed this barrier. The required change represented too big a shock to established ways of working. IT infrastructure was insufficient, or organizational silos impeded commitment to and execution of the required change. In short, leaders became enthusiastic about investing in tech at the start of the pandemic, largely because it was the only way to preserve business continuity while ensuring employee safety. But that ended up being a catalyst for a dramatic change in organization strategies. For all the ways in which the past year has been without precedent, None of these trends are going to evaporate whenever we come out on the other side. If anything, the opposite is more likely. These trends are going to become more entrenched and more closely connected to business outcomes down the line. Forward-thinking leaders will operate with that in mind, using these trends as a foundation for thinking critically, investing strategically, and making necessary changes to their business model. Now, digitalization and digital transformation will also demand proper regulation and transparency in the use of data. The phrase, data is the new oil, coined in 2006 by Clive Hambing, the British mathematician, has been repeated and amplified. On the other hand, with some obvious exaggeration, the technology thinker James Brittle said in a book in 2018, data is the new nuclear power. Data is a valuable, powerful commodity, but it also has an enormous capacity for harm. The vulnerability of digitalized systems to a bad use of data has already given us some examples. And cybersecurity risks must be tackled. Last week's ransomware attack on meat processing giant JBS, a Brazilian company, but in this case, its subsidiary in the US, raised the issue of food security as a national security threat caused by criminal hacking. And it was just a month ago that the US faced a ransomware attack on the Colonial pipeline, which escalated energy security concerns and led to panic buying of gas by consumers. The recent targeted attacks on critical infrastructure controlled by private enterprise are a strategic ploy by hackers to hit companies at key points in supply chains and more effectively leverage ransom demands. And there are consequences in commodities and consumer markets. So we need both cybersecurity as well as security against misuse of data, something that can only happen with appropriate regulation and oversight to some degree. Now, let me move to the second topic, digitalization of finance. The financial industry is undergoing rapid technological change, a trend reinforced by the pandemic. Traditional banks face competition from online startups with no physical branches. Social media and other digital platforms are expanding into payments and credit. The increase in demand for digital service triggered by COVID-19 is turbocharging this transformation. The confluence we are witnessing is driving fintech innovation and raises important questions. What are the transformative aspects of recent financial innovation that can uproot finance as we know it? Which new policy changes will the transformation of finance bring? One transformative aspect of recent financial innovation is information. New tools to collect and analyze data on customers, for example, for determining credit worthiness. The increasing use of new types of data coming from the digital footprint of customers' various online activities, mailing for credit worthiness analysis. This is the new reality. Credit scoring using so-called hard information, income, employment, time, assets, and debits, is nothing new. Typically, the more data is available, the more accurate is the assessment. But this method has two problems. First, hard information tends to be procyclical. It boosts credit expansion in good times, but exacerbates contraction during downturns. The second and most complex problem regarding information is that certain kinds of people, like new entrepreneurs, innovators, and many informal workers, might not have enough hard data available. Digitalization of finance resolves the dilemma by tapping various non-financial data, the type of browser and hardware used to access the internet, the history of online searches and purchase. Recent research documents that once powered by artificial intelligence and machine learning, these alternative data sources are often superior to traditional credit assessment methods. and can advance financial inclusion by, for example, enabling more credit to informal workers and households and firms in rural areas. Now, another transformative aspect of recent financial innovation is communication. New approach to customer relationships and the distribution of financial products. Communication innovation is driven by the variety of digital platforms in social media, mobile communication, and online shopping that have penetrated much of consumers' everyday lives, thus increasing their digital footprint in the available data. Platforms like Amazon, Facebook, or Alibaba incorporate more and more financial service into their ecosystems, enabling the rise of new specialized providers that compete with banks in payments, asset management, and financial information provision. Technology again boosts an existing trend. The shift from in-person bank branch visits to remote online communication generally improves customer convenience and makes financial intermediation more cost efficient. It also boosts geographic competition among banks, which can now service more distant customers. The effects of digital transformation are powerful for the financial sector. Already, the industry most heavily reliant on computers. This is compounded by the doubling in use of online banking in the past 2 decades in the European Union's 15 largest economies. And with usage at 50% on average, it still has significant room to grow. Now, policy challenge. Prudential regulation face perhaps the most substantial challenge. Regulators need to assess the operational risks of new lending technologies and business models facing their first real-life stress test during the COVID-19 downturn. Other risks also loom large. More cybersecurity risks. Financial institutions and customers using more online service create potential new opportunities for criminals. And regulatory arbitrage, tailoring business models to reduce regulatory oversight. To address all these challenges, regulatory agencies need to ensure that their expertise matches that of the industry, something historically difficult that may become even harder as more talent enters the financial technology sphere and the pace of innovation accelerates. Other critical areas include competition policy to address the monopolistic tendencies of large digital platforms related to network effects and the natural tendency to converge to a few large platforms. And data policies to ensure consumer privacy and efficiency and safe collection, processing, and exchange of data, something that we alluded to in the first component of our talk. Overall, while much of the technological progress in finance is evolutionary, its pace is accelerating fast. Fintech's potential to reach out to over 1 billion unbanked people around the world and the changes in the financial system structure that this can induce can be revolutionary. Now, third topic, taxing tech, where we are also watching a substantial landscape change and with implications directly on the region. The arguments and the political desire to tax the digital companies and more in general, the digital economy have strengthened as an outcome of the coronavirus crisis. Digital companies have increased their profits during the crisis in contrast to those companies that lost lots of their profits. Furthermore, like elsewhere, the fiscal and quasi-fiscal responses to the pandemic by European Union leaders have led them to think of how to deal with budget finance and increased debt. To help pay for it, they look toward bigger companies, the world's technology giants. The agreement reached by G7 finance ministers in London last week on global tax reform, requiring the largest multinational tech giants to pay their fair share of tax, is a landmark. It may become a worldwide regime for the world's largest companies with a global minimum rate. That would end a 3-decade race to the bottom in corporate taxation, particularly because of the commitment to a global minimum corporate tax of at least 15%. and most likely a broader accord at the G20 meeting in Venice in July will also be achieved. The agreement refers to the largest global companies with profit margins of at least 10% as having to allocate 20% of their global profits to countries where they make their sales. This is a dramatic change from the practice of international corporate taxation, where profits are taxed only where companies have a physical presence. There are details still to be defined with respect to what defines the largest global companies, which will demand some broader kind of accord later in the year. But obviously, big tech companies will be there. The agreement has broad implications. For instance, it will reduce the incentives for large companies to declare profits in tax havens or low tax jurisdiction, such as Ireland, because the country in which the company is headquartered will be able to top up corporate tax payments to the global minimum effective level. Before such an agreement, I don't have to tell you, the EU leaders had agreed in principle to introduce a digital levy with details to be put forward by now, mid-2021. While it wouldn't be the largest source of revenue for the pandemic budget, it could be a big step forward in how European countries tax corporations. The plan, I'm talking about the plan outlined last year, added a long-standing push to reevaluate how the tech titans pay taxes and address how countries around the world can claim their fair share of revenue they help generate. And some countries have already chosen to enact digital service taxes individually, taking a stand and drawing a backlash. And that's why in the recent past, the United States opened trade investigations against countries from France to Indonesia, claiming such taxes unfairly single out American companies. Not by chance, the most contentious issue last week was the US demand for France, UK, and Italy to drop their new digital taxes in return for gaining taxing rights in the deal. The US wanted to be immediate, while European countries insisted they would abolish these taxes once any global agreement had been sealed and ratified. The communique of the G7 meeting promised to be followed by specific commitments, or, let me quote, appropriate coordination between application of the new international tax rules and the removal of all digital service taxes and other relevant similar measures on all companies, end quote. And indeed, absent a multilateral solution, there would be a serious risk of unilateral measures being further taken at country or regional levels, and those measures might trigger sanctions or trade tensions. That's why the announcement came as great news. So, bottom line, the pandemic accelerated and revolutionized history by speeding up the digital economy, including finance. But the tally in terms of policy, regulatory, security, fiscal, and institutional adaptation is remarkably high. Thank you very much.